Okay, so my name is Paul Ferguson. I'm from an organisation called Sensible Money, and primarily what we're trying to do is educate about modern banking practices, ultimately as a means of resolving the debt crisis. We do have a proposal for how we would like to see the economy run, and I'll talk about that at the end. But for the moment, I just want to talk about the current monetary system, and in particular I want to talk about where money comes from. So the obvious answer is that money is printed, and sure enough, a small amount of money is still printed. Just to give you an idea though, only about 3% of our money exists as cash and coins. The other 97% is digital money, and it consists of the numbers in our bank accounts. That's really what money looks like today. It's the numbers in your bank account. Now it's this 97% that we're trying to educate about. Not many people are completely familiar with exactly how it's created, and even fewer are familiar with how it disappears during a recession. So put as simply as possible, digital money comes from bank loans. Because if you get a loan from a bank, it's not actually a loan of pre-existent money. It doesn't come from other people's deposits or from banks' reserves or anything like that. The bank creates the money for the loan by typing new balance into your bank account. Now, not everybody believes me when I say that, but the following quotes from central bankers should confirm. So this comes from Paul Tucker at the Bank of England. Banks extend credit by simply increasing the borrowing customer's current account. When banks make loans, they create additional deposits for those that have borrowed. Each and every time a bank makes a loan, new bank credit is created, new deposits, brand new money. Money is primarily created through the extension of bank credit. The commercial banks can create money themselves. And finally, from Mervyn King at the Bank of England, when banks extend loans to their customers, they create money by crediting their customers' accounts. Now, this actually makes perfect sense from an accountancy point of view as well, and indeed nothing else does, because if you get a loan from a bank, you leave with a higher bank balance and a new debt to the bank. So your bank balance is a liability of the banks, so it goes up, they make a credit entry. Your debt to the bank, it goes up, they make a debit entry, and that is how money is created these days, all right? If anyone feels that a loan is sourced from some fund or whatever, just ask yourself, what account would the bank credit the money from, and what will be the corresponding debit entry? Now, because the vast majority of our money is created in this way, it means every euro has a corresponding debt. In fact, it's even worse than that, because banks only create the principal of the loan, and yet they expect the principal plus interest back. So each new loan actually creates more debt in the economy than it does money. Now, I want to talk about the money multiplier model of banking, and this is the nearest that economics comes to explaining where money comes from, and the story unfolds as follows. So the central bank might print a new €100 note, and that will make its way into circulation. Eventually someone will deposit that with a bank, and the bank will write down new balance €100. The bank might keep a little bit aside and lend out the rest, so they might keep €10 aside, and somebody might borrow €90 from them. Now eventually that €90 will change hands, it'll get deposited with a bank, and the bank will write down new balance €90. Exact same thing happens again, the bank might keep €9 aside and lend out 81. Eventually the 81 changes hands, it gets deposited with a bank, and that bank writes down new balance €81. So under this system, there's only €100 of cash in the world, but it's actually several bank balances now. One reads 100, one reads 90, one reads 81, and this process continues. And each of these bank balances behave as if they're money in the economy. And this is known as the money multiplier effect, and it's the nearest that economics comes to explaining where money comes from. Now, it doesn't actually apply for a number of reasons, the most obvious of which is that this would only actually apply if banks process loans in cash form. So just to go right back to the start, let's say the central bank prints a new €100 note, someone deposits that with a bank, the bank writes down new balance €100. If a second customer walked in to borrow €90 of the bank, at this stage they'd leave with a higher bank balance and not the cash, and the model just immediately breaks down. Even if this model is extended to take account of how things happen electronically, so instead of printing a €100 note, the central bank might create €100 worth of central bank reserves. This model will only actually apply if those central bank reserves were taken out of interbank payments as each loan is processed. And of course that doesn't happen. So this model of banking just doesn't apply anymore. Now it's a really popular model, and it sort of depicts banks as intermediaries. All the while they're just lending existing money, comes from other people's deposits. They're only really indirectly creating money through each loan. And it is a really popular concept, this idea that banks are intermediaries. It pops up all over the place. I have a few examples. This comes from an economic think tank called Redefine, and from their own website they say they advise several governments, international agencies and non-governmental bodies on a number of key policy themes. And in 2010 they wrote a paper called How to Design a Good Banking System, and they describe what banks do in that paper, and they say while individual banks cannot create credit, the banking system as a whole does exactly that. And above it is a description of the money multiplier. $100 is deposited, the bank keeps 10, they lend out 90, and so on. So these guys advise several governments on a number of key policy issues, but they just don't understand the modern banking system. This comes from the Central Bank of Ireland. They're saying credit institutions' total domestic deposit liabilities traditionally have been the main funding source for mortgage supply. Or in other words, mortgages are funded from other people's deposits. But of course that's just not the case. Now if that were the case, banks could never lend out more than they had on deposit. And when that happened, again, central bank doesn't want to acknowledge that banks are creating money to lend. So they're suggesting that much of the surplus was sourced from the United States. And the word intermediary appears after that as well. So this model of banking, with banks being intermediaries, is really popular. This is probably the worst example. This comes from the BAL Committee on Banking Supervision at the Bank for International Settlements. So these are the guys who wrote the BAL Accords 3, and they decide what liquidity coverage ratio a bank should have. They decide what capital adequacy ratio should keep a bank safe, and so on. And in their introduction to their publication on the BAL Accords 3, they say banks are at the centre of the credit intermediation process between savers and investors. So again, they seem to think that banks, first of all, take money from savers and use it to lend out to investors. No acknowledgement here that banks are creating the money they lend. Where does money go during a recession? Well, if everybody starts saving money, it can feel like there's less money during a recession, but a far bigger contributor to there being less money during a recession is the fact that when you repay a loan to a bank, the money no longer exists. Now, if it's the first time you've heard that, that'll definitely need some explanation, but it does make perfect sense from an accountancy point of view as well. If you repay a loan to a bank, you leave with a lower bank balance and a lower debt to the bank. So they debit your account and they credit their debtor's account. So two accounting entries go down, and that's it. That's why the money just doesn't exist anymore. Now, if anybody feels it does, or if anybody thinks that the banks are hoarding money somewhere, just bear in mind, what account would they debit the money to, and what will be the corresponding credit entry. So that's why there's less money during a recession. When you repay a loan, the money no longer exists. Now, this is a lesser known fact, so don't have as many quotes on this, but I do have some. Every loan, overdraft, or bank purchase creates a deposit, and every repayment of a loan, overdraft, or bank sale destroys a deposit. If all bank loans were paid, no one would have a bank deposit, and there would not be a dollar of currency or coin in circulation. And finally, from Mervyn King again, what the banking system has been doing is destroying money. And he was referring to loan repayments when he said that. Now, we have a couple of guides on the Eurozone monetary system. So on the left there is kind of the layperson's guide for us. This is called How Banks Create and Destroy Money. And not only does it explain everything that I've just explained there, but it also explains how the central bank creates central bank reserve money. If you transfer money from here to some bank in Spain or whatever, exactly how that affects the ECB's balance sheet and so on. The graphics are quite pleasant in it, and the language is as simple as we can keep it. So if nobody's familiar or wants to get more familiar with how the monetary system operates, this is a good guide. If you're already familiar with accountancy, you could jump straight into our academic paper on this, which is How Money is Created and Destroyed, a guide to the Eurozone monetary system. And that just explains everything as well, but just a little bit more technical language. And it shows actual balance sheets and so on. Now, if nobody, or if there's anyone who doesn't really want to read up on this, our sister organisation in the UK, Positive Money, have a really well-paced video series on this called Banking 101. So their website is www.positivemoney.org, and their video series is called Banking 101. Okay, so there's lots of consequences of creating and destroying money through bank loans. It means every euro has a corresponding debt, basically, and that does have serious consequences for us. So I would say this is a system unfit for purpose, really. When you bear in mind that money is supposed to be a helpful thing that allows us to trade, it is unfit for purpose in that sense. You know, we have an incredible productive capacity, really, and we have people who put in the work, they do their 9 to 5 and so on, and we can't really ask much more of them. But lots of people just can't afford the products that we might otherwise be able to afford if we had a more sensible monetary system. So we just can't enjoy the fruits of our own labour, essentially. I would say the debt crisis is caused by this system. I know that might be quite a sweeping statement, but to create every euro with an even higher debt, it's absolutely no surprise that we've ended up with an over-indebted economy. Bear in mind, reducing our debts doesn't help as well, because of course the money just doesn't exist anymore once you do that. Unaffordable housing and the mortgage arrears problem. So, unaffordable housing, first of all. When a bank is deciding what project to create money for, it's incentivized to create money for a project that involves a real world asset. So, the housing market, for example, or the construction market. So that's really the essence of the housing boom and the construction bubble and so on. Banks are less concerned about creating money for a project that involves an increase in something that might contribute to GDP, for example. The mortgage arrears problem is definitely caused by this system, because you have to bear in mind that banks only create the principal of the loan, they expect the principal plus interest, so at any one moment we actually owe more to banks than exists. Now, I just want to be careful here. It is just about mathematically possible for all loans to be repaid for a couple of reasons. The accountancy is complicated, so I won't attempt to explain it, but when you repay a loan to a bank, they effectively delete the principal of the loan and they record whatever interest you've repaid them as profit, and ultimately they pay your staff or whatever. Ultimately that money ends up back in circulation. So if all loans are repaid slowly enough, it is just about mathematically possible for all loans to go according to plan. Now, in practice it's not, because as people concentrate on repaying their loans, everybody's bank balance tends towards zero. So obviously long before it gets to that point, somebody's going to default on a loan. And ultimately, it's just not possible for all mortgages to be repaid under this system. We certainly pay higher taxes than we otherwise might, because when the central bank prints cash, again, the accountancy is pretty complicated, but the effect is that it becomes a source of non-tax revenue for the Department of Finance. Now, back in the 60s, for example, 20% of the money supply existed as cash, and 80% existed as money on the ledgers of the banking system. So this 20% cash was a hugely significant source of non-tax revenue for the government. Now, that 20% has dwindled down to 3% today, and that's ultimately the reason why the government's in a position where it's trying to invent new taxes or raise existing taxes. Unemployment, well, this is caused by lots of different factors, but at the same time we do have people willing to work, and we do have work to be done. Generally, it's just a lack of a medium of exchange to bring everything together. So this unemployment can be traced back to this system. Environmental damage, so there's a number of different factors. I think the main one, I won't go into too much detail, would just be planned obsolescence. So under this system, whereby every euro has even higher debt, it's just not feasible to run a company without having a constant income stream a matter of months down the line. So companies do plan for their products to become obsolete in a matter of months or require an update or whatever it is. Whereas that was never so much the case in yesteryear, and this does have environmental consequences. Many of our social problems can be traced to the fact that every euro is created with a corresponding debt and deleted then as debts are repaid. You know, a lack of money can be the source of a lot of our social problems. I just want to talk about how unique this recession might be as well. So this is a graph of the money supply in the UK going back to the 60s. And you can't really make it out from there, but that red line back in the 60s was 20% of the green line. So 20% of the money supply existed as cash, essentially. Now, that's a totally different economy to do business in. Only 80% of the money supply has a matching debt under that system, and it's entirely possible for business to continue without the complications of loan defaults, because the 20% acts as quite a buffer. Now, almost overnight, when we invented computers and digital money, this 20% went down to 3%. And we're now in the situation where we have today, which is a totally different economy to try and do business in. There's only 3% of a cash buffer, and 97% of the euros have a much higher debt to the banks when you take into account compound interest and so on. And loan defaults and the complications of instability and so on are just a feature of the modern economy. Now, we have had a sort of 3% cash money supply since the 70s or so, and we feel what's kept the system functioning apparently well since then is this quite dramatic increase in the money supply. So in actual fact, the money supply has doubled about every 10 years, or it's quadrupled about every 20 years. And that's really quite a huge expansion. If you take out a loan in the 70s and over the course of the next 20 years, the money supply quadruples, your loan can feel quite manageable. If you take out a loan today where it's not feasible that the money supply will quadruple over the next 20 years, you're really going to struggle with your loan. So it should be obvious from this graph that it's not feasible that we can expand the money supply by that sort of a rate for the foreseeable future. And as such, we would actually think that this is sort of the end of the road for this particular system of banking. Certainly the end of the useful line of this system of banking. As well as that, mortgages have always been able to increase in duration. So mortgages at one stage just took one income 5 years to repay. That increased and so on. Eventually 2 incomes got involved, and we're now at the point where it takes 2 incomes about 30 years to repay. So one way or another, we feel that this system just can't really go on, certainly can't go on smoothly anyway. So this is the M3 money supply in the Eurozone, and again we can see this doubling of the money supply about every decade, and that's what we feel has kept the system going. So with that in mind, where to next? Well, this is where we would like to see the economy going, and this is the plain money system of banking. And in a nutshell, we would just get the central bank to create the entire money supply, both cash and digital, and we would get banks to just deal with existing money only. Banks would just do banking, essentially. So to control banks from creating money through loans, we would have 2 types of accounts. So everybody would have a current account, and that would do all your daily transactions. If anybody has surplus money that they wanted to invest into a bank, they would open up a savings account or an investment account. Now, the money in your current account would be perfectly safe. If you have money and essentially only you can use it, all right? The money in your savings account, you would be investing that with the bank. You would expect that to grow, and ultimately only the bank can use it. So that separation stops the creation of money with a corresponding debt through loans. Now, if we have an expanding economy, an expanding number of products and services and so on, the smoothest way to accommodate that is just to have the money supply to grow somewhat in line with that. Now, under this system, not only is money not created through loans, but money isn't actually destroyed through loan repayments either. If you borrow from a bank, you borrow from their investment pool that people have put into the savings account, and if you repay a loan to a bank, it goes into that investment pool first of all, and when the original investor's contract matures, ultimately they get that money. So no money is ever deleted under this system. So we would have a permanent money supply. Now we would need to top it up somehow, and to do that we would get the central bank involved. Now they would control inflation, and ultimately they would decide how much money to create. So they would look at lots of different things. They would look at the population and the demographics of the population, so population growth. They would also look at things like credit card activity might indicate that more money was needed in the economy. If there was unexplained unemployment somewhere, that might be an indication that more money is needed. They would also look at the money supplies of their main trading partners and so on. And ultimately they would come to a decision on how much extra money the economy needs. At that point they would type it into the government's bank account. That's how they would create it. And the government's role in the economy would be to control budgets, and they would decide how best to spend any new money. Now in terms of designing a system that's open to as little abuse as possible, we feel this is as good as it can get. You have to bear in mind we'd have a permanent money supply at this stage, so rarely would money be deleted. So it's not like we would constantly have this need for new money all the time. The exact same money would circulate in the economy and fund several different projects. Now, as a result, the central bank wouldn't be deciding to create huge quantities of money, so they wouldn't have this huge amount of power. Equally then, the government would only be receiving a relatively small amount of new money, so it's not like they would have a huge amount of spending power under this system. So I want to talk a little bit more about current accounts. So first of all, there'd be no risk with current accounts at all. If you have money in there, there'd be numbers on the computer screen. At that stage, we would declare all bank deposits as legal tender, and your money would just be perfectly safe. Now, because the bank is storing the money perfectly safe for you, and because they're providing this efficient means of transferring the money, a charge may apply for having a current account. So that is one drawback of our proposal. If a bank went bankrupt, whatever numbers are in your current account would be perfectly safe. They would just move to the bank of your choice, all right? Consequently, there would never be a bank run under this system. There would also be never be an interbank run, because banks wouldn't really mind what was in the reserve account of other banks. It wouldn't affect them. And consequently, there would be no need for deposit insurance. There would also never be a bank bailout under this system. A savings account are a bit more complicated. If you put money into a savings account, you want it to grow, and risk would apply, and you would know that, and you would agree a risk level with your bank. You might also agree the nature of whatever loan you want to fund. So if you put money in there, only the bank can use it. It goes into the bank's investment pool. If a borrower comes along and meets their approval, the bank would lower the money in its investment pool and put it into the borrower's account, and so on. Now, banks would consult with you before investing, so you would be able to make more ethical decisions, I guess, on what you would like your money to be invested in. So I'll just show a couple of examples here of savings accounts just to demonstrate exactly how they might work. So this would be an example of a low risk, low return investment account. So this might be a housing market loan to middle income families. And the bank might charge the families or the borrowers 6% interest, and it knows that it can expect a return of perhaps 5.8% after a handful of people default and so on. Now, in an absolute worst case scenario, it might expect a return of 2%. So in this sort of type of a low risk, low return investment, the investor or the saver might be guaranteed a return of 1.5%. All right. This would be an example of a high risk, high return savings account. So this might be an emerging industry, tipped to become much bigger. Nobody's really sure if it's a bubble yet or at that stage. And consequently, it's quite risky. So the bank might offer 6% to potential savers or investors, and it might expect a return of 10% from anyone who borrows money at that risk level. Now, if everything goes according to plan, the borrower will repay 110% of the money they receive, and ultimately that gets split between the original saver and the bank. But in a worst case scenario, the bank might only get 70% of the money that it lent out. And in that case, it might guarantee investors 75% of their original investment. Now that is a high risk, high return investment, and of course there would be everything in between there. All right. Now I just want to emphasize as well that it would be entirely possible under this system for all loans to just go according to plan. It wouldn't be the case that every euro had a corresponding debt and it was impossible to repay all loans. At any one moment, at least 70% or so of the money in the economy would be stored in current accounts and hence perfectly safe. So again, if an individual investment just didn't work out, it wouldn't have a real big effect on the economy. So again, all this is documented in our publication, Resolving the Eurozone Debt Crisis, a guide to the plain money system. And this is on our website at www.sensiblemoney.ie. Now it is 38 pages long, so it goes into as much detail as you might like. If anybody isn't really that interested in it, you can just read the overview, alright, which is in the first section. And that basically explains exactly what I've just explained there. But if anybody really wants to get into the nitty-gritty of the accountancy procedures that banks will follow and so on, we have all that in a separate section. If anyone wants to know how we would gradually transition to this system over the course of the next 30 years or so, all of that is explained in the document. And finally, there's a section on concerns that we have with our own proposal and how we might deal with that.